Welcome, all you multifamily enthusiasts, to another episode of the Multifamily Real Estate Experiment Podcast. This one is going to be powerful because we're talking today with a subject matter expert in commercial real estate. This is a guy, he's a powerhouse for 15 years in the industry. Started in house hacking. He quickly moved into flipping houses in Detroit, funding Renaissance real estate venture at Encore Real Estate Investment Service. He now excels as a senior director focusing on commercial real estate from shopping center to resort. Beyond real estate, our guest today is a former Amazon executive and a dedicated family man with five children. Like, this is one of the things that makes him a powerhouse, right? Because it's a lot of commitment. So he lives in Birmingham, Michigan, and enjoy running, boxing, lifting weights, yoga. Who does yoga, right? Only the people that want to live a long, healthy life, and playing acoustic guitar. So our guest today, Dan Lewkowicz, has been a friend to us, to H-Way Capital, for a few years now. We have networked back and forth, and we're looking forward to having this powerhouse drop some really good information on us today. So the question we're going to ask is, how can you diversify your investment? How can you diversify your investment portfolio through Triple Net Leasing?
Yeah, thank you very much. I really appreciate being here. Obviously, we've known each other for a long time, and I always enjoy interacting with you. I'm going to have to update that bio soon because another 2 months, I'm expecting number 6.
Oh, good man. All right. Do you have a favorite real estate quote or mantra that drives you?
Definitely. I mean, I have it on the back of my mug from the course that I created. It's
Okay.
provide value and everything else follows. I believe in that to the nth degree. The way I run my business, I don't focus on the goals, and the outcomes are important, but I focus on providing value in the here and now. And I find that everything else follows from there.
That is awesome, man. I did a lot on your bio. Is there anything else that you focus on right now that you want to share with the audience that would add value to talking about Triple Net Leasing?
Yeah, my focus is as a net lease investment sales broker, which means that I sell single tenant net lease properties like Walgreens and Starbucks and Burger King and dollar stores and medical office buildings, et cetera, as well as shopping centers, your neighborhood multi-tenant retail or retail and office shopping centers. And triple net lease is really what I eat, sleep, and breathe. I'm happy to discuss anything in that arena or anything in the commercial real estate arena for that matter.
That's good, man. All right, we got short time. You have a job that time. You're busy, man. You got a lot of stuff going on. So let's want to put a lot of value in your time. So look, let's dive right into it, man. So let's start with the basics for our listeners that might be new to the concept, right? Can you explain what Triple Net Leasing is and how it differs from other type of leasing?
Yeah, absolutely. The way that I like to describe what net lease is to compare it to something that a lot of people are familiar with to show you what net lease isn't. So I'm going to give you 2 examples. We're going to compare and contrast them. So first of all, let's take your typical Wendy's property. Maybe it's off the highway. You've driven past them pretty much every day of your life. Now, this particular property, the tenant is paying $125,000 of rent every year. That's their base rent. So if you look at your profit and loss report, your top line gross income, $125,000. You go down the street, what do you find? Got a small apartment complex. We're going to maybe tweak the numbers a little bit just for the purposes of an example, but we'll still prove our point. So it's a small apartment complex, also bringing in $125,000 of gross collected rents, okay? Top line number on your P&L there, your profit and loss report, $125,000. So first glance, they're exactly the same. Now, if you look at the apartment complex, we have to dive a little further, right? Because it's not going to just be your gross collected rents in terms of calculating your net operating income. You have expenses, right? You have management expense. You've got some vacancy. You've got capital expenditures. You're going to have to deploy some CapEx to fix things like the roof and the parking lot. You're going to have regular expenses like cutting the grass and shoveling the snow and salting and plowing the parking lot. You're going to have to pay for taxes. You're going to have to pay for insurance. You're going to have to pay for utilities. Maybe at the end of the day, you've got 50% of that 125 left over. Maybe you've got, let's just not be that conservative, say $60,000 in expenses. So you're left with, what is that, $65,000 in net operating income. Now let's go back to the Wendy's, right? Remember, top line number, gross collected rent, 125, exactly the same as the apartment complex. But now let's look at the expenses or the lack thereof. With the Wendy's property, this is going to be what's called an absolute triple net property. So in that case, the tenant pays your taxes. The tenant pays your insurance on your building. The tenant pays to salt and shovel the sidewalks and salt and plow the parking lot. They pay to cut the grass. They pay for any management. If there's a leak in the roof, they pay for it. They pay for the taxes. They pay for, I already said, the insurance. They pay for all utilities. At the end of the day, your expenses are zero. And this is where the word net lease comes from. Your $125,000 of rent is net to you, the landlord. Your net operating income, 125,000. That's an absolute triple net lease because all three of the ends are taken care of by the tenant. Taxes, insurance, paid for by the tenant. Common area maintenance, all forms of maintenance of the building, taken care of by the tenant. And then last but not least, roof structure and parking lot, taken care of by the tenant. Now, as a little caveat, there's something called a double net lease, which is exactly the same. However, the landlord is responsible for the roof and structure, and in some cases, the parking lot. But I just wanted to give an overview and use the absolute net lease, the cookie cutter, bread and butter, coupon clipper, mailbox money type deal where you have no responsibilities whatsoever. And that gives a good comparison of net lease to multifamily.
One of the things I didn't hear was the mortgage. Who covered the mortgage?
That's going to always be the owner's responsibility.
Okay, gotcha.
If the owner pays cash, there is no mortgage. If the owner doesn't pay cash and has financing, they're going to have to cover the mortgage. One of the things that a lender is going to look at with a net lease deal, obviously they're going to like the security, the stability, especially if it's a large guarantor on the lease. They're going to like the fact that it's the demographics and the population density and traffic counts and all that. But what's very important to them is what's called, what a lot of people know about, the DSCR, the debt service coverage ratio. And all that is a ratio between your debt service, meaning how much it costs to pay your taxes, your mortgage, your principal and insurance every month, versus the income of the property. That number varies lender to lender, but typically they're looking for 1.15, 1.25, 1.5, all depending on different things. I've seen them down to 1.05 in certain incredible assets, but basically they want to make sure that you're able to replace your debt service should that tenant leave.
No, that makes sense. So let's go into the question number 2, right? So looking back over the past, decade or so, what significant trend have you observed in the commercial real estate markets, particularly in absorption and popularity of triple net leasing?
Yeah, so it's just the overall trends. I look at commercial real estate from a simplistic sense in many cases. Correct. And if you want to look at how robust is a market, what type of transactional volume is going on, there's really only one factor, one variable that's going to influence that to the greatest degree. And that's simply the delta or the difference between the cost of borrowing capital and cap rates. So if the cost of borrowing capital is 3% and the cap rate is 5%, okay, you've got 200 basis points, 2% spread. Okay, yeah, there's going to be movement. People are willing to borrow at 3% and buy at 5, 6, 6.5%. We lived in an era of artificially low interest rates for a long time. For most of the period from the housing crash until really March of 2022, our interest rates were incredibly low. We're talking 2.75, 3%, 3.5%, 4%, incredibly low. In the 80s and late 80s, early 90s, interest rates were between 12 and 18%, like nothing we can think of. So the market was really hot 2015, 16, 17, 18, and then it got on fire in middle of 18, 19, 20. Then COVID hit, right? Yeah. COVID knocked everything off the tracks for about 4 months. And then what happened? Government lowered into the treasury, went to zero. The 10-year treasury went to zero, and interest rates went even lower, and $10 trillion of money was printed, and there was stimulus after stimulus, and the market just was even hotter if that was possible. Then what happened in March of 2022? Interest rates started to rise very rapidly, probably the most rapid, largest increase in interest rates in about 40 years. And that really put a damper on transactional volume. We saw brokerages who lost 70, 80% of their transactional volume. My team was able to pivot a little bit into different assets that were still, trading, and we've done very well. But overall, that's where we're at. And we're at a point right now where we're at about 11, 12 months of the Fed keeping interest rates stable, completely stable. I had thought we'd have one or two before the election. I still believe we will have at least one before the election. Just from a political perspective, it seems like the thing to do. But I really believe until we start seeing 2 or more consecutive interest rate decreases, the market's going to stay where it is because cap rates haven't really risen tremendously.
Right.
interest rates have. So that delta I talked about has become a thinner and thinner margin.
Yeah, I think one of the things I'm seeing that is stabilizing cap rates or not causing a big decrease or deflection in cap rates is because there's still good fundamental, especially markets that we're looking in, fundamentals in the markets, and the good operators are keeping the properties occupied and performing based on their projection. And the only thing that's really affecting their ability to exit a lot of these properties is the person who's buying the property cannot really pencil it out because of the cost of borrowing capital. I see this slow rise in cap rate, but not drastically.
Right.
Now, for the triple net listing you're talking about one building, a strip mall, a big mall, right? What are some of those properties that typically used for the triple net leasing, especially if an individual or an investor want to go down this route of buying properties for the triple net lease concept? What are some of the properties that these investors are looking at?
A lot of them are single tenant net lease properties. So it's
Okay.
one building, one tenant. Sometimes you're dealing with an entire shopping center, right? And
Right.
in other cases, you have a shopping center that it's not a freestanding building,
Right.
but that building is parceled or condoized separately. So
Hmm.
people will sell that building. Those come with their own challenges. There's no way to say this one's better than the other. A single tenant net lease property has a lot of stability and security if you've got a strong tenant, but there's no diversified income stream, right? If they leave, you have to re-tenant the building, which can be an
Right.
expensive endeavor. On that note, I always advise my clients when buying a single tenant net lease property that you have to make sure that you have a replaceable income stream, right? Buying a pharmacy that is paying $25 a foot, while that sounds amazing, if you're in a market that only commands $12.50 a foot and they leave, you're in big trouble.
Yeah.
Now, if you want to look at a little bit more diversification, higher cap rates, and in some cases, so significant upside potential, I love shopping centers because shopping centers have that delta, right? Today you can get financing at about 6.75, and there's a lot of shopping centers that trade at 7.75, 8, 8.5, 9, 10
Okay.
caps. So you can still get that delta if you want to. Additionally, another benefit of shopping centers is that you can force appreciation very similarly to how you do it in multifamily, right? You can buy a property that maybe has some deferred maintenance. You can deploy some capital expenditures, make it a little more appealing, get better tenants, get
Right.
rid of bad tenants. If your tenants are approaching a renew, if their lease is rolling over, you could raise the rents to market rent. You can get, like I said, better tenants with better credit. And then my favorite part is a lot of times in these shopping centers, they have what's called gross leases, the opposite of what I spoke about in the beginning. A gross lease is where the tenant pays base rent. Let's say they're paying $15 a foot, right? But that's gross. The landlord is responsible for all other expenses. Now, the other type of lease in a shopping center is a triple net lease, where the tenant pays base rent, but they also pay pro rata share of the expenses. So if the
Gotcha.
shopping center has $100,000 in expenses and this tenant occupies 1,100 square feet out of 10,000 square feet, their pro rata share is 11%. So guess what? They pay $11,000. So what you can do is you can convert those gross leases over to net leases. And that does three things. Number one, it gets rid of the flexibility and unknown of what your expenses are going to be because it's on the tenant now. Number two, it can up your net operating income. And then number three, it can even lower your cap rate because investors prefer to buy a triple net leased shopping centers. Doing all these things, deploying CapEx, getting better tenants in, evicting bad tenants, raising rents when appropriate, converting gross leases to triple net leases. Those are all going to lower your cap rate and increase your NOI, which is going to significantly impact your bottom line value of your property. So that's a great play for people who want to find a way to force appreciation in net lease.
We talk about start out with a single win. We're talking about the potential strip mall or shopping center. Now, so I want to ask you, man, how has the demand in triple net leases evolved over the years? And have you seen a shift in the type of property or sector that are more inclined towards this leasing structure?
Great questions. Over the years, pharmacies became very popular because they were credit tenants with great reputations, huge corporations. They were paying high rents. The real estate was typically top shelf, A plus real estate. Main on main corners, high traffic counts, great visibility, great proximity to other national retailers, great demographics, population density, average household income, traffic counts, et cetera. Obviously, that has shifted, and that's a whole nother conversation. I think more recently, car washes have come into favor
Oh yeah.
for a variety of reasons, but from a private equity and developer perspective, the reason is car washes utilize a subscription model. And when you have a subscription model, these private equity companies can load them up and then trade them on an equity multiple because the business has a built-in income stream. They know how much they're going to be collecting. And then whatever those are trading at in the private equity world, those can be spun off and sold. Now, from the investor side, the reason that they've been attractive is because they qualify for bonus depreciation, which has had some changes over the last few years, which I think startled people. But it used to be you could get 100% bonus depreciation in the first
Right.
year, meaning if the year that you put a property into service, you could do a cost segregation and have all the depreciation in year one. Now you can get 80%. It's going to change. It's probably going to go back the way it was, but as it sits now, it's going to get lower and lower. So I think that bonus depreciation has been a big factor for this overbuilding of car washes. And in terms of what's going on right now, we've seen a big shift. And this, I'm very thankful that 2.5 years ago, I pivoted and stepped more into three sectors, right? The vacant property sector, which I had a lot of experience with, the short-term lease sector, also had a lot of experience, and the shopping center sector, which I had a lot of experience in. All three of those sectors have been less affected by these interest rate changes, right? So there's been a big push to redevelop excellent real estate that's been vacated. And that's just going to become more and more of a hot topic because a lot of major retailers have filed for bankruptcy. Now, the retail world is alive and well. Retail vacancy nationwide is at 4.1%, which is an 18-year historic low. However, there have been a lot of corporations who have filed bankruptcy. It just happens. That's what's going on. It's evolving. So as it evolves, those vacant boxes are going to be repurposed and they're going to be brought to their next highest and best use. Same thing with short-term lease deals. When their lease expires, developers will repurpose them. And then obviously shopping centers, I already touched on a few moments ago. Just a lot of opportunity. The real push into shopping centers is driven by that delta we talked about, right? The delta between borrowing costs and cap rates. That delta doesn't exist in a lot of the single tenant net lease world that's trading at the 5 or 6 cap space. But in the 7, 8, 9, 10 cap plus space of shopping centers, you have that delta. So that's why there's been a migration into that space.
Now, some of the things I was going to ask you about the trends you're seeing, you already answered some of my question, man. So I appreciate that.
Sure.
Now, I want to ask you this one though, man. From a tenant perspective, right? What are some of the primary benefits and drawback for entering into a triple net leasing, a triple net agreement?
Listen, the drawback is you have to pay all expenses, right? If
Right.
if the cost of gasoline and salt goes up and your bill to plow the parking lot goes up, that's on you. You have to pay for it. I think one of the major benefits for the tenant is the stability and the fact that it's a known variable for them. They've locked into 10, 15, 20, 25 years of tenancy at this location. And in most triple net leases, you have options at the end. Let's call it, most typically it's 4 or 5 year options. So it might look like a 20-year lease, but from the tenant's perspective, they've got an additional 20 years where they can say 5 years at a time, yeah, we want to stay here. So that's huge. These retailers, they don't want to leave. If they find real estate and that's where they feel like they want to be, they don't want to leave. In many cases, these retailers have tremendous rent to sale ratios. And when I say tremendous, tremendously low. So the ratio between how much rent they're paying and the sales they're doing is very low. In the case of quick service restaurant, a healthy quick service restaurant is doing 7 or 8% rent to sales. If a retailer is spending that little in rent, they don't want to leave. They want to keep making their dollars. So that's a huge benefit for the tenant. And we've had a lot of these arrangements with developers who are the ones that build the properties, ink the leases with the tenants, and create value by getting certain rents and developing for a tenant that trades at a low cap rate. And it's been a win-win for everyone involved.
Got you, man. So I want to talk about it now from a tenant perspective. And I want to talk about it from an investor perspective because it sounds like there's more predictability, especially when you have a large tenant in one of your single building or a strip mall or even a mall, right? We've seen some of these companies go out of business or close stores, right? But some of these companies, the large box stores, they've been around, retail stores, they've been around for some time, hundreds of years, and they're looking to expand in a good economy. For a listener who are investors, what are the key benefits of investing in properties with triple net leasing, and how does these leases contribute to a more stable and a predictable stream of income?
The key benefits are that stability of the income stream, right? And the fact is that you look at your lease, everything is written in your lease before you buy the building in
Yeah.
terms of what to expect over the next 20 or more years, right? Even the rental increases are built into the lease if there are rental increases. So you know exactly what to expect. So there's that stability, that predictability, maybe is the better word. If
Right.
you're dealing with a major national tenant that has a strong guarantee, there's your stability,
Mhm.
right? You've got a strong credit backing your lease. Even if they don't do well in that one location, they can't just leave the lease. That is, they could leave the location, but the actual lease is guaranteed by hundreds, if not thousands, of locations. So that's huge for the investor. Again, the hands-off passivity. If it's an absolute triple net lease, you don't even need to see the property.
Yeah.
You don't have to worry about. I sold a Burger King where we were getting ready to market the property, and I realized the Burger King was not open for business. I got in touch with the tenant. Tenant told me that somebody had driven a car all the way through the building.
Oh,
The
wow.
landlord had no idea. Why? Because the tenant was responsible to continue paying the rent. The tenant had the insurance. The tenant had to do the rebuild. And this owner was like, oh, I had no idea. I've been getting my checks every month. I don't live in Texas. That is a plus, that hands-off aspect, not having to do anything, not having to worry about anything. I think that although this is a very niche, unique space, there's all different types of net lease properties. So if you're considering buying one, you really want to reach out to someone like myself to help you understand all the different nuances between all the product types within net lease to choose the one or the ones that are best for you.
Right. Okay, so now we'll talk about some risk mitigation. And we kind of fire through the next three questions, right? What are some of the risks associated with triple net leasing, and how can investors mitigate those risks effectively?
Great question. So with single tenant net lease, we touched on this a little bit before.
Yeah.
It's going to be the fact that you don't have a diversified income stream. You've got
Right.
one tenant. If that tenant does leave, you have to repurpose. And now, by the way, if there's a strong guarantee and they leave, there's a good chance that they have to keep paying you, but there's a good chance that they're going to want to negotiate a buyout where they give you a certain percentage of what
Right.
you're owed. And in many cases, investors can come ahead on that. So that's great. One of the ways to mitigate that is to make sure that you're buying a property that does not have above market rents. I can't stress this enough. Or going to the multi-tenant space where if you lose a tenant that's 8% of your gross leasable area, it's not going to make you cash flow negative.
I got you. Now, so let's talk now about lease negotiation, right? So when negotiating the triple net leasing, what are critical terms and clause that both landlord and tenant should pay close attention to?
So this question, just to clarify, is probably more for a developer
Okay.
perspective. The next call I have today is a property that I'm intimately involved in. It's actually a Starbucks development. And in that case, the owner negotiated directly with Starbucks in terms of the terms for the build to suit. So he's wearing a developer hat, right?
Got you.
But if you or I are coming in and buying the Starbucks once it's on the market or once it's available for sale, there's zero lease negotiation that we go through because we're buying a property that has a lease in place.
Got
Obviously,
you.
as a developer, there's lease negotiation. And then if you're in the position where your property is vacant and now you have to find a new tenant, yes, there's lease negotiation there.
Got you.
There's going to be the lease duration. How long is your lease? There's going
Right.
to be your rental rate. There's going to be, are there rental escalations? And if so, what are those rental escalations? Number four is going to be options. As a landlord, by the way, options give you zero benefit. All options do is they provide the tenant the opportunity to stay there should they so desire, but they can say no, they can leave. So I don't like options as a landlord.
Mhm.
As a tenant, I would like options, obviously. Those are all very important. And then another variable that's going to be important is who is signing on the lease, right? I've seen guarantees of CVS Woodward LLC or CVS Detroit LLC. An owner might think they're getting a corporate guarantee when really they're getting a small entity guarantee that has only 5 stores. So that's going to be very important. Who is signing on the lease? And then this doesn't always come into play, especially not with the national retailers, but
Right.
with the smaller tenants, it does. Is there a personal guarantee? And if so, what is that individual's net worth? Do I have a personal financial statement that shows me what their net worth is? Do I have documents that confirm that and validate and back that up? So that's all going to be very important. And then obviously, depending on how the lease is structured, you're going to want to negotiate, is this an absolute triple net lease or is the tenant not willing to pay for roof and structure. What about HVAC? Again, absolute triple net lease, none of this applies. It's all on the tenant. But if
Right.
you're dealing with a double net lease or something like that, what about HVAC? Does the tenant have to repair the HVAC, but the landlord has to replace it?
Replace.
These are
Yeah.
all little nuances that definitely need to be negotiated.
That's good, man. So appreciate that information. Now let's focus on, as we bring this podcast to a close, I want to focus right now on future projections. So looking ahead, what are projections for triple net lease markets in the next 5 years? Are there any upcoming trends or potential disruption that investors should be prepared for?
Listen, I'm sick. I can't even hold my breath any longer in terms of
Yeah.
interest rates coming down. But that doesn't matter. I think the professional real estate world feels the same way I do. In my opinion only, I don't believe that we can sustain these relatively elevated interest rates much longer. And the number one factor is just, frankly, our country's debt, right? It now costs us over $1 trillion a year in interest payments only to service our debt. So without getting too deep, the way that it works is that the US government or our country's debt is cycled, right? So we're constantly borrowing money. When notes come due, we have to replace that. So the problem is, and this is what caused a bunch of the bank failures that we saw last year, when you're holding paper that is at a certain interest rate and now you have to replace it with a much higher interest rate, your debt service goes up quickly. That's exactly what's going on here. So I don't believe, unless we raise the debt ceiling or unless we default, which we would be catastrophic, we can't do that. That should not be an option. Those words shouldn't even come out of my mouth. But unless that happens, which it's not going to, we have to find a way to bring our debt service payments lower. And I think this is the only solution. So I personally believe that the commercial real estate market, and especially the net lease market, is healthy. Yes, certain sectors that are not healthy, office market, not healthy in general, with the exception of Class A office. But if you look at everything else, especially retail, it's healthy, it's vibrant, it's strong, even under the most grueling of conditions. And those are these oppressive interest rates,
Yeah.
right? So I believe that once we see, like I said, 2 or more consecutive interest rate decreases, I think that's going to be the fire that's going to light this powder keg up. And I see great things ahead for the net lease market and the commercial real estate market. I think there's going to be pain simultaneously, right? All those operators who borrowed at 2.5%, 3.5%, and didn't have rate caps or have their debt coming due in 5 or 7 years, which is like now, they're going to feel the burn. And it is what it is, right? But the overall commercial real estate market, especially net lease, I believe is going to be healthy. And as soon as those interest rates go down, it's going to continue its push forward. So I'm very optimistic and I see great things. I think people buying around this time are going to be happy 5, 10 years from now when they see their values increase.
All right. I got 5 questions for you, like real fire round. What do you currently do for fun?
I'm a big car guy, as I love cars. In fact, a couple of years ago, you pushed me. You asked me why the model of the Viper on my desk was only a model. Listen, I've got one in my garage now.
What is one opportunity that was a game changer for you?
One opportunity that was a game changer?
Right.
Definitely just the opportunity to be a commercial real estate broker. It's changed my life in every way, and I couldn't be more thankful.
All right. What's your favorite communication tip?
My favorite communication tip. That's a tough one. There's a few that come to mind, but I would say that communication needs to be clear, it needs to be direct, and it needs to have a purpose. I think that's so important. Keep it clear, keep it direct, and make sure that it has a purpose.
Perfect. What is one thing you wish you understood earlier?
It's definitely that there's so much more value in listening and learning than in showing people what you know, right? I'm on podcasts several days a week, so I get to show people what I know.
That's good.
When I was younger, I wish I would have recognized the value in trying to learn from others more than trying to show them what I know.
And last question, to what do you attribute your success?
I would say it's just stick-to-itiveness,
Okay.
I think
My word, dude.
Yeah. It's more important than knowledge. It's more important than education.
Yeah.
Because if you stick to it enough, it's like running. If you were running a race that the only goal was to go further than your competition, if you just keep going, that's how you win. That one extra step gets you success, because 9 out of 10 people gave up there. And now you've only got one other person with you and you keep going. Same thing. I'm not trying to say you have to compete against people, but if you have stick-to-itiveness, you'll be able to weather any storm and ultimately you'll get through it and see that success.
2 words I want to make very popular is stick-to-itiveness and figure-outable.
I love
All right, brother. So Dan, if our listeners want to get in touch with you, how do they go about doing that?
Yeah. So first of all, I'm very active on LinkedIn. You can follow me there. I put out daily content, almost all of it related to commercial real estate, some car
Okay.
stuff. My first name is Dan, last name Lewkowicz, Lewkowicz. Again, Lewkowicz. Reach out to me, send me a message. I know where we know each other from. Additionally, I'm going to give out my personal cell phone. If you want to know what your property's worth, if you want to buy property, sell property, if you have questions about commercial real estate, if you're looking into getting into brokerage or investing, or you just want to talk commercial real estate, I love when people reach out. So please, it would be my pleasure. My cell phone is 248-943-2838. Again, 248-943-2838. It'd be my pleasure to be in touch.
All right, my man. So Dan, I want to thank you again for joining us on this podcast. And listeners, that was a fire episode and a lot of actionable information, a lot of good insights. So I want to thank you again for listening to another episode of the Multifamily Real Estate Experiment Podcast. I'm Hutch, the Marine Investor. Happy investing. Out.